There's a number the US government doesn't like to talk about. Not the $36 trillion national debt you see in headlines. The other one? The $38 trillion in liabilities that don't technically count as debt. Medicare obligations, Social Security promises, federal pensions. Money the government will owe but hasn't borrowed yet. And right now, there's a plan in motion to make a lot of it disappear. Not through austerity, not through some bipartisan miracle, through something much quieter, much older, and completely legal. They're going to let inflation do the work. Let's back up. When you hear national debt, you're hearing about treasury bonds. IOUs, the government sold to investors, foreign countries, pension funds. That's the $36 trillion everyone argues about. It's real, it's tracked, it sits on a balance sheet, but unfunded liabilities, those are promises. Social Security checks to retirees in 2040. Medicare coverage for people who aren't even sick yet. The Congressional Budget Office estimates these obligations at around $76 trillion over the next 30 years. Subtract the revenue they expect to collect, and you get that $38 trillion gap. Now here's the uncomfortable part. There's no law that says the government has to keep those promises. Social Security isn't a contract, it's a program. Congress can change the payout formula tomorrow if it wants. They can raise the retirement age. They can mean test benefits. They can trim cost of living adjustments. And that last one? That's where inflation comes in. Inflation is a hidden tax. You've probably heard that before. But here's what it actually means in this context. Let's say you're promised $2,000 a month in Social Security starting in 2040. That sounds like a decent amount right now. But if inflation runs at 3% a year for the next 16 years, the purchasing power of that $2,000 will be cut nearly in half. You'll still get your $2,000 check. The promise is technically kept, but it buys what $1,200 buys today. The government hasn't cut your benefits. Inflation did. This isn't a conspiracy theory. It's monetary policy. The Federal Reserve has a 2% inflation target. They've said it repeatedly. 2% doesn't sound like much. It sounds responsible even. But over 30 years, 2% inflation reduces the real value of a dollar by about 45%. Over 50 years, closer to 64%. And when the Fed undershoots that target, like they did for years after 2008, they don't just shrug it off. They try to make up for it. They've explicitly said they'll let inflation run higher than 2% for a while to average things out. That's not a fringe idea. That was the official policy starting in 2020. The implication is, inflate away the debt. Here's the math they don't put in press releases. The US government currently pays about $1 trillion a year in interest on the national debt. That's more than the defense budget, more than Medicare. It's the second largest line item in the federal budget after Social Security. But here's the thing, most of that debt is fixed rate. A 10-year Treasury bond issued in 2024 at 4.5% will pay 4.5% until it matures, no matter what happens to inflation. If inflation runs at 3%, the real interest rate the government is paying is only 1.5%. If inflation hits 4%, the government is actually earning money in real terms on that bond. They're paying you back in dollars that are worth less than the ones you lent them. This is why governments love inflation. It's a slow-motion default that doesn't trigger a panic. Bondholders still get their money. Retirees still get their checks. But the purchasing power quietly erodes. The obligations shrink in real terms, without anyone having to vote on a benefits cut. And the beauty of it, from the government's perspective, is that no one feels responsible. The Fed says they're just trying to keep the economy stable. Congress says they're just trying to honor commitments. And inflation? Inflation is just this thing that happens. It's the weather. Now you might be thinking, won't people notice? Won't bondholders demand higher interest rates if they think they're going to be paid back in cheaper dollars? They already are. That's what the bond market is. It's a giant negotiation over what inflation will be and what interest rate compensates for it. When inflation expectations rise, Bond yields rise. The government has to pay more to borrow. But here's the trick. The Fed controls short-term interest rates. And when they want to keep long-term rates low, they can just buy the bonds themselves. That's what quantitative easing was. The Fed created money and bought trillions of dollars in treasury bonds and mortgage-backed securities. They pushed rates down by sheer force. This is the quiet part. The government borrows money. The central bank buys the debt. The debt gets paid back in currency the central bank created. It's a loop. It's not technically money printing because the bonds still exist on the Fed's balance sheet. But in practice, the government is funding itself. And when inflation ticks up, the real value of all that debt shrinks. The Fed doesn't have to sell the bonds back into the market. They can just hold them to maturity and let inflation do the work. Let's zoom out. Japan has been running this playbook for 30 years. Their national debt is over 260% of GDP. The Bank of Japan owns nearly half of it. Interest rates have been near zero for decades. And it works, sort of. Japan hasn't collapsed. The yen is still a currency. But Japanese retirees are also living in an economy where wages have barely grown, savings earn nothing, and the promises made in the 1980s feel like a different universe. Europe tried a version of this after the 2008 crisis. Negative interest rates, massive bond buying. The European Central Bank became the largest holder of government debt in multiple countries. They called it unconventional monetary policy. But unconventional has been the convention for 15 years now. The US is just better at making it look normal. So what's the catch? Why doesn't every government just inflate away their problems? Because inflation isn't a precision tool. It's a wildfire. You can start it, but you can't always control where it goes. Inflate too much and people lose faith in the currency. Bond markets revolt. Interest rates spike. Suddenly the government can't afford to borrow at all. That's what happened in the 1970s. That's what happened in Argentina, in Turkey, in Zimbabwe. The central bank's job is to walk the line. Enough inflation to erode the debt. Not so much that the system breaks. It's a high wire act, and the longer it goes on, the thinner the wire gets. There's also the moral hazard. If the government knows it can borrow recklessly and inflate away the consequences, what's the incentive to ever be disciplined? Why cut spending? Why raise taxes? Why make hard choices today when you can just make tomorrow's dollars worth less? This is the trap. Inflation becomes the path of least resistance. It's easier than voting for entitlement reform. It's easier than raising the retirement age. It's easier than telling retirees their benefits are getting cut. Instead, you just let the money rot a little bit every year. And here's the really uncomfortable part. It's already happening. Social Security's cost of living adjustment is based on the Consumer Price Index, but the CPI has been adjusted over the years to reflect substitution effects and quality improvements. If steak gets too expensive, the formula assumes people switch to chicken. If phones get better, the formula says you're getting more value for the same price. These adjustments make sense in theory, but in practice, they systematically understate inflation as retirees actually experience it. Healthcare costs and housing costs, which are huge for seniors, don't get weighted the same way. So every year, the COLA might say inflation was 2.5%, but the real cost increase for a retiree might be 4%. That gap compounds. Over 20 years, a retiree on a fixed cost of living adjustment loses 30% of their purchasing power compared to what they would have kept with true inflation protection. The government didn't cut benefits. The formula did. This is how you quietly erase $38 trillion. You don't announce it. You don't vote on it. You just recalibrate the measuring stick. So what happens next? The US has three options. 1, raise taxes and cut benefits enough to actually fund the promises. Politically impossible. 2, default. Legally catastrophic and economically suicidal. 3, keep inflating and hope the music doesn't stop. Right now, we're on option 3. The Fed will say they're managing inflation. The Treasury will say they're funding critical programs. Congress will say they're protecting seniors. And all of it will be true, in a narrow technical sense. But the big picture is simpler. The government made promises it can't keep in dollars that will be worth what they're worth. And the plan, whether anyone admits it or not, is to let time and inflation do what politics can't. The $38 trillion isn't going to disappear. It's going to shrink, slowly, quietly, legally. And by the time people realize what happened, the checks will have already been cashed. Here's the question no one's asking. If this works, if the US manages to inflate away a generation of promises without triggering a crisis, what does that mean for the next generation of promises? If you're 30 years old right now, paying into Social Security, watching the Fed print and Congress spend, why would you believe the money will be there when you retire? Maybe that's the real cost, not the dollars, the trust. If you value clarity over noise, like the video and subscribe.